Gold in 2026 is everywhere in the headlines, on social media, and in investor conversations, and today we are breaking down the real question every smart investor is asking right now. Is gold in 2026 the biggest opportunity of the decade, or is it a carefully hidden trap waiting to snap shut? Welcome back to the Stock Predictor channel, where we cut through noise, hype, and fear to focus on facts, logic, and smart investing decisions. Over the last few years, gold has shocked many people. Prices moved higher even when interest rates stayed elevated. Central banks kept buying, and retail investors rushed in looking for safety. But as we move closer to 2026, the environment is changing again. Inflation is no longer running wild, global growth is slowing but not collapsing, and investors are becoming far more selective about where they park their money. So the question is no longer should you buy gold, but when, how much, and why. To understand gold in 2026, we need to understand why gold exists in a portfolio in the first place. Gold is not a growth asset like stocks, it does not generate cash flow like businesses, and it does not pay dividends like bonds. Gold's real power is psychological and structural. It is a hedge against uncertainty, currency weakness, geopolitical risk, and loss of trust in financial systems. Whenever fear rises, gold demand rises, but when confidence returns, gold often underperforms. One of the strongest arguments for gold in 2026 comes from central banks. Over the past few years, central banks around the world have been quietly accumulating gold at record levels, reducing dependence on the US dollar and diversifying reserves. This trend did not happen overnight and it is unlikely to reverse quickly. As long as geopolitical tensions remain elevated and global trade blocs continue to fragment, gold remains strategically important at the sovereign level, and that creates a long-term floor for prices. Another major factor supporting gold is currency debasement. Governments continue to run massive fiscal deficits, debt levels are historically high, and even if inflation appears under control on the surface, the long-term purchasing power of fiat currencies continues to erode. Gold historically performs well in environments where people lose faith in paper money, and while we are not in a full-blown currency crisis, the seeds are clearly visible, especially in emerging markets. But here is where things get interesting. Not everyone believes gold is a no-brainer in 2026. Well-known investment banker Sarthak Ahuja has openly warned that buying gold blindly at high levels can be risky. According to his analysis, one of the most overlooked signals is the sharp slowdown in physical jewelry demand, especially in price-sensitive markets. When gold prices surge too fast, real demand often collapses, and that can lead to long consolidation periods or even painful corrections. Jewelry demand matters more than people think, because unlike ETFs and futures, physical demand reflects real consumer behavior, weddings, festivals, and cultural buying habits. When consumers step back, it signals price exhaustion, and in recent times, high gold prices have forced jewelers to cut production, offer discounts, and reduce inventory, which is not a sign of a roaring bull market. Another risk for gold in 2026 is interest rates. Even if central banks start cutting rates slowly, real interest rates may remain positive, and that is not ideal for gold. Gold thrives when real rates are negative, when holding cash or bonds guarantees a loss in purchasing power. If inflation cools faster than rates fall, gold could struggle to justify its valuation. Then there is the opportunity cost. In a world where artificial intelligence, energy transition, and infrastructure rebuilding are driving massive capital flows into equities and real assets, gold starts to look less attractive to younger investors who want growth. Many investors under 40 see gold as boring, slow, and unproductive, and if risk appetite returns strongly in 2026, capital could rotate away from gold into stocks, crypto, or emerging markets. So is gold a trap in 2026? Not exactly, but it can become a trap if you misunderstand its role. Gold is not meant to make you rich quickly, it is meant to protect what you already have. Investors who go all in on gold expecting explosive returns are often disappointed. The real danger is buying gold at emotional highs, driven by fear, headlines, and social media hype. Now let's talk about the opportunity side, because dismissing gold entirely would be a mistake. Gold shines brightest when markets break, not when everything looks fine, and history shows that major financial stress rarely announces itself in advance. Banking crises, geopolitical shocks, sudden inflation spikes, or currency collapses tend to happen when people feel most comfortable. Owning gold before chaos hits is far more effective than trying to buy it during panic. Another underrated advantage of gold in 2026 is portfolio diversification. Gold has a low correlation with stocks over long periods, which means it can reduce overall portfolio volatility. Even a small allocation of 5 to 10% can improve risk-adjusted returns, especially during drawdowns. This is why many professional investors still hold gold even when they are bullish on equities. How you invest in gold matters just as much as whether you invest in gold. Physical gold offers emotional comfort but comes with storage, security, and liquidity issues. Gold ETFs are efficient, transparent, and liquid, making them ideal for most investors. Sovereign gold bonds, where available, offer interest income on top of price appreciation, making them one of the smartest ways to own gold long-term, while digital gold can be convenient but requires careful selection of platforms and understanding of regulations. Timing also matters. Instead of investing a lump sum at market highs, a staggered or dollar-cost averaging approach reduces risk. Gold often moves in cycles. Sharp rallies are followed by long sideways periods. Patient investors who accumulate during consolidation phases tend to do much better than those who chase breakouts. For investors watching silver alongside gold, there is another layer of opportunity. Silver has a dual identity. It is both a precious metal and an industrial metal, driven by demand from solar panels, electronics, and electric vehicles. Some analysts believe silver could outperform gold in the next cycle due to industrial demand, but silver is also more volatile, making it unsuitable for conservative investors. The biggest mistake investors make with gold is treating it like a prediction rather than protection. You do not buy gold because you know the future. You buy gold because you do not know the future. Gold works best as insurance, not as speculation. When viewed this way, the question shifts from will gold go up in 2026 to what happens to my portfolio if everything else goes wrong. Let's be honest, if markets remain stable, growth continues, inflation stays moderate, and geopolitical risks cool down, gold may deliver mediocre returns in 2026, but if even one major shock hits the system, gold could suddenly justify every dollar invested in it. That asymmetry is what makes gold unique. So how should a smart investor approach gold in 2026? First, avoid emotional decisions. Do not buy gold because everyone else is buying it. Second, limit allocation. 5 to 15% is more than enough for most portfolios. Third, choose efficient investment vehicles. Fourth, think long-term. Gold is not a trade, it is a position. For traders, gold can offer opportunities through short-term volatility, but that requires discipline, risk management, and experience. For long-term investors, simplicity wins. Buy gradually, hold patiently, rebalance periodically. At the end of the day, gold in 2026 is neither a guaranteed jackpot nor a useless relic. It is a tool, powerful when used correctly, dangerous when misunderstood. The biggest opportunity lies in using gold as part of a balanced strategy, while the biggest trap is expecting it to do what it was never designed to do. If you are looking for safety, diversification, and insurance against uncertainty, gold deserves a place in your portfolio. If you are chasing fast money and explosive growth, gold will likely disappoint you. The smartest investors understand both sides and position accordingly. This is not about choosing between gold or stocks, fear or greed, opportunity or trap. It is about balance, discipline, and clarity. And as we move into 2026, those qualities matter more than ever. If you found value in this breakdown, make sure to like the video, subscribe to Stock Predictor, and share this with someone who is confused about gold right now, because in investing, clarity is profit, and confusion is cost.